Hey guys, stick with me to the end of this video and I'll show you why I think Applied Digital is one of the best buys right now in the stock market. Stay tuned to the end and I'll prove it with a DCF. Applied Digital, ticker APLD, operates blockchain data centers, cloud services, and HPC infrastructure with revenue mix shifting towards AI workloads and away from the blockchain. So APLD operates three main business segments focusing on AI HPC infrastructure, data center hosting, and designing, building, and operating custom data centers to support the HPC and AI applications. Going on a little further, some of their core assets you can see here include the Polaris One, which is going on a little further, the campus in North Dakota, which has a 250 megawatt capacity, which uses a closed loop liquid cooling system to improve their GPU efficiency. Their cloud services provide GPU cloud solutions for AI training and machine learning, and they're moving away from the cryptocurrency infrastructure. I saw a video talking with their CEO Wes Kuman, talking about how Applied Digital built Polaris here before they even had a single customer, which is kind of insanity. And now they have the upper leg here with being the world's largest liquid cooled AI factory. And you can see that they're starting to make waves here in the market with reading the headline. Applied Digital announces 250 megawatt AI data center lease with CoreWeave has sent the stock price exploding. So why North Dakota? It's interesting because lately there's been a trend of these hyperscalers pivoting more inland. There's cooler temperatures, cheaper electricity, cheaper real estate, and APLD is set up. Let's dive more and talk about this North Dakota and why they can capitalize on this trend. So this is directly from APLD here, and you can read along, I'll break out the cursor. The strategic advantages of North Dakota. The site selection combined with cooler climate can reduce annual operating costs by 50 to 60 million compared to other existing 100 megawatt data centers, resulting in savings of billions over 30 years. This is the hyperscalers are going to be eyeing up this opportunity, the Googles, the Microsoft. Um, North Dakota generated 50% more energy than it uses. Okay. There's low build and operation costs in North Dakota. They have a favorable climate. They have economic incentives from the state to reduce capex, and they have the first mover advantage in the sense that the state's locked in energy prior to the AI movement. So I want to take a second and kind of discuss the convertible debts because they can have a significant impact to equity shareholders via dilution. The company purchased and, in my eyes, protects shareholders via a couple instances. One, they purchased a cap call derivative from dealers, essentially buying call options on its own stock to act as a hedge for when the bondholders convert the debt. The company also used part of the proceeds to buy back its own shares, immediately reducing the shares outstanding and, kind of counteracting that future potential dilution. The company also can force early redemption or conversion if the stock price, hits the threshold, the gray highlighted section there to the right. And they can allow the company to manage, these notes proactively by redeeming in cash if the stock's low or forcing a conversion when the stock's high. Overall, the structure raises cheap capital, 450 million at 2 and 3/4, while capping the dilution risks with the cap call, and often seen as shareholder friendly compared to traditional straightforward equity issuances or unhedged convertibles. Looking at the revenue statement today, not all that impressive, but it worrying not where we're at today, but where the company's heading. But historically looking, mediocre performance here. Revenues from 22 to the LTM of 8 million to 170 million. So you like to see that growth, but unfortunately, you can see everything below is red, indicating losses. The company still does not make money or profit, and they're not expected to for a while, especially with these capital expenditures to build out these data centers, Polaris 1, 2, and extensions. Now let's just rip through this balance sheet real quick because I'm really only curious. When I see a balance sheet, I'm asking what are the biggest assets, what's the cash, and what's the debt. So real quick, just taking a look, 2.3 in assets. Biggest asset obviously is their plant property and equipment, which is the physical data, Polaris one, the building. Then they have 74 million in cash and 382 in short-term debt, 305 in long-term debt for about 687 million in long-term debt, so about almost 10 times the amount of debt than they have cash. I'm not the biggest on, multiples. I think it's a good spot check for your DCF, but just because someone paid a price in the market, I don't think that is cause for that to be the price. So I use it as spot checks, but it's just interesting to highlight here. If you're looking at it from a multiple perspective, it's very expensive, right? 30 times price to sales, 32 times EV to revenue, 100 times EBIT. If you look at the trailing, 60 times EV to revenue, 55 times price to sales, 1700 times EBIT. It's not cheap. This is why it's important in my eyes to look at the discounted cash flow because you're going to see why it's cheap. And the company had terrific Q1 2026 earnings report. If you look at earnings per share, they had expected negative 16 cents and hit an actual 7 cents by beating estimates by 56%. And on revenue, they were expected to hit 45 million and hit 64 million, beating expectations by 41%. And analysts are starting to pick up the stock and raise price targets. Here, I just put one to the side from HC Wainwright, and they have a price target doubling from 20 to $40 when it was trading at $34. Here I pulled the most relevant analysts after that quarterly report. So anything after 10-1 I didn't include, but there you can see our guy we just talked about at the firm, H.C. Wainwright, Kevin Today, his $40 price target, and other analysts, 37, 41, 40, 37, 43, and I still think they're a little low on their price targets here. Jensen Huang holds a position in applied digital. And when you're at the forefront of AI, the forefront of the company with NVIDIA, I mean, he has his head on his shoulders, and I'd be following him into whatever investment he made in the AI space. So the stock saw some pretty nice movement here. I think like a 13, 15% movement today. Uh, but anyway, the stock currently trades at $37.30 and has a market cap of nearly 10.5 billion. All right, now time for the DCF, and I'm going to try to run through this as quick as possible because I don't want to bore everyone. So essentially what I'm doing is I'm building from revenue, and how I'm getting revenue is I'm looking at how many megawatts Polaris over time from now till 2034, then the terminal period forever can produce. So from Polaris 1 and Polaris 2 build out, they're saying by 2032, they think that they can have, 3,000 megawatts or 3 gigawatts, worth of electricity. So if we take a look here to 2033 and 2034, I'm growing that just at sustained industry growth rates expected over 10 years. And then I have the terminal growing by 4% for conservative assumption. So now we're saying what is the price per megawatt, right? So, and here you can take industry reports for $1.83. This is how much their deal with CoreWeave is, and then over time, predicting with combined with industry analysis, what they can get up to is about $2.25. And I think this is conservative because I think there is going to be this electricity is going to be scarce and more expensive resource in some time to be, but going downward, then there's a 1,000 watts in 1 megawatt, or I'm sorry, 1,000,000 watts in 1 megawatt. So then you do 450 times 183 times a million will get you 823 and a half million. So scale that all the way out, and we get 8.2 billion in the terminal period is what we think they can get in revenue based off of a $2.25 charge on their megawatts, and they can produce 3,640 megawatts or 3.6 gigawatts, however you want to term it. Their problem, what we've described in previous slides, is that they're not profitable, right? And they're not expected to turn a profit here until 2031. And at 2031, they're expecting anywhere from the 35 to 50% range. So I'm scaling from 35 and staying conservative in the terminal until 40%. From there, it's just simple multiplication. You'll multiply your revenue by your free cash flow margin, and then you'll get your free cash flow. So negative, 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 and then you start to hit into the positives and all the way into perpetuity, where we think they'll make 46.8 million here in free cash flow. So what does that mean for the company? Well, the present value of this, right? Because a dollar is worth more today than tomorrow because you can invest it. You guys know should know the equation here. One divided by one plus the interest rate raised to the period minus a half is how you get this. And we're using an 11% discount right here, and that's how you get these numbers, right? So the further you go out, the less money you're willing to pay, right? Because into forever from now, I'm only willing to pay you 40% of what it's worth based on an 11% return. So that gives us a sum of free cash flows of just about 20 billion. And then they have 74 million in cash they can use to put down and pay the 700 million in debt, giving us an enterprise value, what you would need to come up with cash to the table to buy this company, $20.1 billion. There's 279 million shares, more towards 280 million shares, which gives us a price target of $71.95. It currently trades at $37.26 with almost a 100% upside. I'm buying. All right, guys, that's all I had for you today. I love Applied Digital stock. Hope you learned something. See you next time.